So let me ask you this, like what benefit would like an investor have? Like, let's say that I had money in the bank and I'm earning 0.00001% on my money. Like, why would I like go invest with or what would be the benefit of maybe investing with you? Like how do you make it worthwhile for somebody to
Yeah.
maybe to invest with you to make it worth your while or make it worth their while like and how are those deals typically structured if possible?
Yeah, yeah. So in that example that I gave you, $10 million building, I'm all into for $7 million. So let me back up for a second. What you need to realize is like there's usually two types of investment opportunities for passive lenders. One is a debt structure, which is like a hard money lender. Let me lend you money and you pay me 12% plus a couple points, or pay me 15% straight return on my investment. And it's if you get rich, they don't. If you lose money, they don't. Right? So like it's very predictable cash flow, and that's great. The other type of option is an equity investment, meaning most commercial real estate deals are done more on an equity investment where somebody puts money in and they play in the upside. So if the property wins in a big way, they make a lot of money. If it doesn't, then they could lose all their money. But the limitation is that there's no predictable, consistent cash flow paid out. And I've realized that most investors want both. And so I've created just a hybrid to pay both. So I'll pay a fixed return on investment. Somebody invests $100,000 and I'll pay somewhere between 6 to 10% on their money while their money's invested. And because I'm doing these value add properties, I can create that appreciation in a fairly short amount of time. Let's call it 2 to 3 years. So I'm able to renovate it, stabilize it, refinance it in 24 months. And let's say the investor made 8% on their money in year one. They make another 8% on their money in year two, regardless of the property's performance. They're making 8% on their money. Then I refinance. They get all their money back. And then they keep a percentage of equity in the deal forever. And so that equity in the deal, on a $10 million building, if I'm all into it for $7 million and they get a percentage of that, that means there's $3 million of equity in the deal. So, obviously if you're holding on to it, they're not going to be able to pull that cash out because it's in the property, but that equity will yield a dividend. It will yield cash flow, right? And every month that the tenants pay their rent, it covers all the operating expenses, covers the debt service, and there's cash flow that gets distributed to me, any of the joint venture partners, and my investors, even though they don't have any money invested anymore. They've gotten all their money off the table. So it's really it's free and an infinite return for them. Then they also get depreciation. Then they get appreciation as rents go up over the course of time. And they get principal pay down on the loan too. Every month we make a mortgage payment, we're paying down the principal amount. And then all of a sudden, 10 years later, that $3 million of equity is closer to like $8 million of equity. And then we sell it and they get a percentage at that time that's probably going to be pretty close to $100,000, maybe $120,000, even though their money's not even involved anymore. So while their money's in, it's nice because they have a predictable cash flow. Then they get all their money back out, and then they have this nice little, almost like an annuity that just pays them cash flow every single month. And then when the property sells, they get these big pops of refinance proceeds or sales proceeds. So it's a pretty sweet deal for them, man.
Yeah. So essentially, the whole point is to find undervalued assets in the marketplace. You find the undervalued assets. You basically structure the deal in a way where it benefits all parties. You improve the income on the property, reduce the expenses. Therefore, you make the building worth more. And then from that point, basically, you can refinance, get most of their money back out, if not all of it. They still get a percentage in the deal, so it makes it a win-win.